Treasury yields were mixed on Tuesday after the start of the new year with a jump. U.S. Treasury yields turned mixed in Tuesday trading, a day after an aggressive and broad-based sell-off in government debt to kick off the new year sent the rate on the two-year note to a 22-month high. What are yields doing? The yield on the 10-year Treasury note MUBMUS 10Y 1.670% was at 1.673%. Compared with 1.628% at 3 p.m. Eastern on Monday. Yields and debt prices move opposite each other. The two-year Treasury note MUBMUST 02Y 0.765% yielded 0.762%, down from 0.784% Monday afternoon. The yield on the 30-year Treasury bond MUBMUST 30Y 2.078% was at 2.082% versus 2.016% late Monday. On Monday, the two-year yield rose to its highest since the 2nd of March 2020, based on 3 p.m. levels, according to Dow Jones market data. Meanwhile, the 10-year climbed to its highest since the 24th of November, and the 30-year advanced to the highest since the 23rd of November. What's driving the market? Investors appeared to wave off concerns over the Omicron variant of the coronavirus that causes COVID-19, with the Dow Jones Industrial Average DJIA pushing into into record territory Tuesday, though tech shares were dragged down by the rise in long-term yield. Treasury prices fell on maturities from 7 to 30 years out, while investor demand for 1 to 3-year government debt pushed those rates lower. COVID-19 infections have surged, with the U.S. registering 1,083,948 cases on Monday, according to data collected by Johns Hopkins University, more than double the previous record of 486,428 set 4 days ago. Hospitalizations for confirmed or suspected COVID-19 cases hit a 7-day average of 97,855 on Monday, according to data from the U.S. Department of Health Human Services cited by the Wall Street Journal. That is up 41% over the past 2 weeks, but below the pandemic peak of 137,510 seen on the 10th of January 2021. And a smaller peak of 102,967 seen on September 4, 2021, amid the surge in the Delta variant of the coronavirus. Investors continue to look for the Federal Reserve to begin lifting rates as early as this spring, with traders pricing in a 61% chance of a rate move in March, when the central bank is expected to end its monthly asset purchases. Data released Tuesday included the Institute for Supply Management's gauge of manufacturing, which dropped to 58.7% in December from 61.1% in November, as U.S. manufacturers coped with persistent shortages. Economists polled by the Wall Street Journal had forecast the index to slip to 60%. Readings above 60% are considered exceptional, and any number above 50% signals expansion. A record for 0.5 million Americans quit their jobs in November, and job openings fell by 529,000 to 10.6 million on the last day of that month, the Labor Department said Tuesday. Meanwhile, Minneapolis Fed President Neil Kashkari acknowledged that inflation has risen higher and lasted longer than he expected. In a separate essay released on his regional bank's website, he said he penciled in 2 rate hikes in 2022 at the December FOMC meeting. Sign up for our Market Watch newsletters here. What are analysts saying? After a somewhat turbulent end to 2021, most risky assets have started the new year on the front foot, and safe government bond yields have risen sharply, said Jonas Gulteman, a senior markets economist for Capital Economic. Provided that concerns about the pandemic continue to fade, we expect equity markets to continue to rise, albeit more gradually than last year, and bond yields to rise further in the coming months.